Hey guys, welcome back to the channel and to another fantastic video this week. I hope you guys are excited for this one. This is probably one of the better videos we've done on the channel, and today is going to be all about ChatGPT, and it's been the rage for about a month or two. If you guys haven't heard about it yet, Google it, watch some videos on it. It is an AI or artificial intelligence type of Google that people can simply type questions in and get various answers. Very useful tool in various ways. But today we're going to take a look at how we can use it for investing and how to expand our investing knowledge. So that's what we're going to be taking a look at today. Look at some terms related to investing, different questions we can ask it that I'll go through. I got 20 various questions that I'm going to be asking. And at the end, we're going to be looking at a paper trading account that I'm going to be setting up. And we're going to be using some investment stocks or whatever ChatGPT wants us to invest in. We're going to get some answers out of it. And then we'll check back in about a month or so and see how that portfolio is doing. So great content today. Hope you guys stick around and enjoy. And I'll see you all next time. Okay, so let's get started. This is what we're going to take a look at today. So here's the first question that I've decided to ask it. How should you make investment decisions based on your risk tolerance? This is a very common question. Let's see what ChatGPT has to say about this. So it says that when making investment decisions, it's important to consider your risk tolerance with the level of risk you're comfortable with taking on. One way to determine the risk tolerance is to consider your investment time horizon and personal financial situation. If we have a long-term investment horizon and a stable financial situation, you might be able to tolerate a higher level of risk and pursue investments with the potential for higher returns, such as stocks or real estate. On the other hand, if we have a shorter-term investment and time horizon and a less stable financial situation, you may want to focus on a more conservative investment, such as bonds or cash equivalents that offer low returns but also lower risk. And so it tells us to diversify across various asset classes as well. So now, what's a good method for diversifying and balancing your investment portfolio? So what it says is it's a good method for doing this is to use asset allocation. It uses it and divides an investment portfolio among various asset classes such as stocks, bonds, and cash. The idea is to spread investment risk across different types of assets and sectors, and in order for them to help them perform well and balance the overall portfolio. It's also a strategic asset allocation approach, which uses a mix of assets based on investment goals, risk tolerance, and time horizon, and a younger investor might allow for higher risk while an older might not. And the other method is tactical asset allocation, which adjusts the portfolio based on market conditions and an economic outlook. This method allows for more flexibility, but it carries more risk. It's also important to periodically review our portfolio and make adjustments as necessary. This is a good answer, in my opinion. So now we can move on to the next question here that I decided to ask it. How risky are equities when opposed to bonds? ChatGPT says, by its research or its algorithm, that equities are considered to be riskier than bonds, which is in fact true, as we know. Stocks represent ownership in a company, and their value can fluctuate widely depending on the company's performance, the economy, and other factors. Stocks can be quite volatile in the short term and can vary significantly in short periods of time. Because of this, they also carry higher risk and there's larger loss limits. Bonds are issued by governments or companies. They pay interest, which is more stable, and the principal is returned at the end. The value can also fluctuate, but is generally less volatile than stocks, and therefore the risks are different. And as a creditor, we get paid first. It's important to note that the different types of bonds with varying levels of risk, and we generally have corporate bonds and government bonds are lower risk. The next question here is, what are some examples of a diversified investment portfolio? So in this case, it spit out and said that it's when it's spread out across assets, sectors, and geographic regions in order to spread risk and potentially maximize returns. Here are a few examples that it gives us. So it tells us to have a balanced portfolio, which balances it between stocks, bonds, and cash, 60, 35, and 5% respectively. And it tells us to have a global portfolio, which says to have a various mix of geographic regions such as the US, Europe, and Asia, and emerging markets. Also sector-specific portfolio, which means that we should invest in sectors such as technology, healthcare, and energy. And finally, a thematic portfolio, which invests in various themes such as social, governance and environment, such as ESG, artificial intelligence, and tech. And these are just some examples it gave us. So the next question I decided to ask it is, should we only consider single name stocks in investment, or should we also include ETFs in this? So what it tells us is when we're constructing an investment portfolio, it's generally a good idea to have a mix of both. Since single name stocks are an investment in a specific company, they can also provide a greater potential for return, but at a higher volatility and risk. But by doing so, we benefit from the growth and also take part in the risk of that. And on the other hand, index funds are aimed to track performance of various indexes such as the S&P 500, and they have lower MERs compared to actively managed funds. This makes them a good option for investors who want to minimize risk and lower their costs. Putting single name stocks and index funds in your portfolio can provide a balance of risk and potential return. It's important to have a good understanding of the risk and return characteristics, and it's also good to review your portfolio. That's what it tells us. On to the next one here. When should we consider purchasing stock options instead of just buying shares? This is one I hear all the time. So what ChatGPT tells us is that stock options are a type of financial derivative, so it kind of explains what options are in a simple way. They can be an attractive investment for some, but it's definitely more risky. Here are just some situations where an investor might consider purchasing stock options instead of a few shares. So in this case, it says that hedging might be a very important thing. So what is hedging? It's when we want to protect us against a specific event with the stock's price, such as an earnings release or a regulatory change. The second is speculation. It can be used to speculate on future price movements of the stock, since it's an option to buy, not an obligation. And finally, for leverage, because it can offer higher returns for less capital up front. And of course, it notes that this is a higher level of risk. It's not suitable for everyone, which is to be expected and noted. So now the next question is, what are some suggestions of good dividend stocks? I was kind of just playing around here seeing what it would give me, but it actually did give a nice list of high dividend paying stocks as far as its knowledge. And again, it's worth noting here that its data stops in 2021, as this was the last time when the data was input into the AI algorithm. So Johnson & Johnson is one that it says offering 2.3% dividend yield, Procter & Gamble with 2.2%, Coca-Cola with 3.1%, ExxonMobil offering up to 4.9%, which is quite high. It gives a quick description of each business as well, which is really nice. And AT&T, which is 6.7%. And it tells us that those dividend yields might change over time, and we should contact a financial advisor if we want to know more. So this is pretty useful. It gives you some actual tickers as examples, not by any means financial advice, but just as an example to get an idea. The next question, what are some suggestions of value stocks and growth stocks? Kind of going off this momentum of it giving me names. So first, it gives a quick explanation of what it is. Again, value stocks are considered to be undervalued by the market, and then they have their current stock price lower than their actual value. And it gives examples such as Bank of America, General Electric, Ford, and Cisco. Growth stocks are the opposite, where they're overvalued compared to the market and their intrinsic value, with higher PE ratios than value stocks. Some that it included was tech stocks such as Amazon, Netflix, Tesla, and Facebook. It's also important to note that the stock market is constantly changing, and the above examples are not considered value or growth stocks at all times. And this is important since this is probably dated in 2021, so not very current. Next question is, what are some good personality traits for an investor to possess? Another good one that I've heard several times. There's various traits that it spits out here, and a few examples include patience. It says because it's a long-term endeavor, it's more likely that we're waiting for returns over a long period of time, so patience is really important. The second one is discipline, which investors are disciplined are more likely to stick to their investment strategy. There's objectivity. Investors who are able to be objective and make decisions based on facts are more likely to succeed. They need to be open-minded to consider different investment opportunities and strategies to find new opportunities. They need to have and know their risk tolerance, since they're more comfortable in their risk tolerance range, and they need to be willing to learn. And it's normal to have ups and downs, it mentions, and it's important to find the right balance of these traits that works for you as an individual. This is pretty good advice. Now, a very controversial one that I typed in next is cryptocurrency a good investment for a portfolio? This is an interesting one since it was a little bit outdated as of the end of 2021, but it still says that it's a pretty risky investment, and suitability is part on the risk tolerance of the investor, which it seems to kind of do over and over. And cryptocurrency has the potential for high returns, but also comes with a high level of risk. Again, this is the same thing. And regulatory environment for cryptocurrency is still developing, which is noted, and that this has a negative impact on its prices, and that it's still very new to the market. Okay, so the next question that we decided to ask was, how often should we be checking our investment account? And this is one I hear all the time since it invokes a lot of stress if you check it too often. So what ChatGPT says is that as a long-term investor, we should not check our investment account too frequently, since it could lead to impulsive decisions, which is very true. And it's important that it's a marathon, not a sprint. It's also generally recommended to check your investment account on a quarterly or semi-annual basis to review the performance and to see if it remains in line with your investment goals and to rebalance as necessary. It also says to review your portfolio periodically to ensure that it's properly diversified and that you are comfortable with the level of risk that you're partaking in. So diversification helps to reduce this risk. Again, it comes back to that. And it says it's a good idea to review the portfolio whenever there's a significant change in your income, employment, or other status. These are all very good points. Next one we could take a look at is, how often should you aim to add funds to an investing account if we are dollar cost averaging? Now, what ChatGPT tells us is that it kind of explains dollar cost averaging in that it's an investment strategy where we add a fixed amount of money into a specific investment on a regular basis, regardless of the price of the investment. By simply adding it over time, we can actually reduce the impact of volatility and decrease our adjusted cost bases over time. The frequency of adding funds to the investment account will depend on your personal situation and investment goals, and some might choose smaller amounts more frequently and others more, but in less or longer time increments. Common frequency is monthly, but this can be semi-annually or annually, or even more often than that. And it's a long-term strategy that requires consistency and patience in order to work. So this is really important to keep in mind as well. Very useful information yet again, and it usually references talking to a financial advisor if we want more information, which is also good advice. The next one I ask it is, what are some characteristics to look for in an undervalued company that we want to invest in? This is a pretty useful piece of information to know. So when we're looking for undervalued companies, it says to look at several characteristics. The first is a low price to earnings ratio. This can indicate that it's undervalued, and because it says its current stock price to its per share earnings, and it uses this to see if it's under or overpriced. The second is a high dividend yield. This can mean that it's undervalued. It's a good measure of the amount of cash paid out to shareholders. The next is strong financials. Of course, this means that it's strong, but yet the price is too low to allow that. Under followed by analysts, which means it has many analysts may be overlooked by the market and considered undervalued, and underappreciated by the market as well. Now, kind of on the flip side of this, we also want to look, instead of value stocks or undervalued stocks, we also want to take a look at growth stocks or overvalued stocks. So I ask it, what are some characteristics for an overvalued company to get rid of from a portfolio or short sell it if it seems to be overvalued? So again, we just get a similar answer here. And it says if we want to get rid of it or short sell it, we should look for a high PE ratio, since this indicates that it's overvalued. The second is a low dividend yield, which is more or less the opposite of what it was before for the value stocks, and it means that the stock is overvalued here. Weak financials can also indicate that it is doing poorly and is overvalued for its intrinsic value. If it's overhyped by analysts or overappreciated by the market, these are also telltale signs that it is an overvalued stock. And again, it tells us to reference in a financial advisor if we want to deal with that. All right, so on to the next question here. So what is some investing advice going into 2023? Now, I decided to ask this partially because it has data only up to 2021, and also just because I wanted to see what it would say in this instance. So it says it depends on the economy and performance of the stock market, which of course doesn't know, but it says to diversify your portfolio, to manage risk and maximize our returns, and to consider investing in stocks, bond, real estate, and other assets to spread out our risk. It also says to have a long-term perspective and to not get caught up in short-term fluctuations. It says to stay informed by keeping up with market trends and the news, having a risk management strategy, which is part of the risk tolerance, and have a plan in place to manage it, and to be patient, which is another part that comes back to the investor characteristics. So it says it's important that past performance does not indicate future performance, and that this is a very important concept. Another question we could ask is, what are some examples of low-cost index funds for long-term investment? Again, here was aiming to see which ones it could build us with low MERs that we could use. So it goes off to explain exactly what an ETF is, and again, these index funds are interchangeable with ETFs. And it shows us that there's various benefits to diversification through using them over actively managed funds. And it gives us examples like the Vanguard 500 Index Fund, which has an MER of 0.14, the Schwab S&P 500 Index with 0.03, and the Zero Large Cap Index, which is actually news to me, which actually has a 0 MER. This is very good to know. And finally, the iShares and S&P 500, the SPY, with 0.03. And here I just told it to continue since it kind of stopped halfway. Not sure what happened there. And the SPY shows a 0.09 MER, which is, again, not bad compared to actively managed funds of 2 to 4%. And again, it just gives us the fact that this is just some examples, and it's focused on one market, the S&P 500, but it was kind of looking at different MER values to see which ones made the most sense here. It is very good that it keeps telling us to contact a financial advisor, that this isn't financial advice, but it's still answering our questions. So now I decided to kind of throw it a question that was directly related to this, which is, why is diversification important for an investment portfolio? As expected, this is a pretty high-level answer, and it said that it's important because it helps to spread out risk and reduce overall volatility. By investing in different asset classes, sectors, and individual securities, you can reduce the impact of any single security or market on your portfolio. And again, it says where to spread it out across, and this can actually help to reduce volatility and increase the likelihood of long-term achievement of our investment goals. You can also help us with the impact of market downturns if it's just in a single sector or single economy, and it can also help us with unforeseeable events. Natural disaster in one area might hurt one area but be good for another if they are doing better somehow. And it says this is overall very important since it helps to spread out risk, which is very true. It helps eliminate idiosyncratic risk, but not systemic risk. So kind of a follow-up question. I was expecting a bit of a similar answer here, which it was, but why do we diversify across countries and industries within our portfolio? So it tells us that some benefits of this includes reduced dependency on a single economy, which again is that idiosyncratic economy-based risk, and various economies such as emerging markets may be doing more poorly or better than our economies, and this can help us kind of diversify that. It also helps reduce currency risk, which is a very important aspect actually, since stocks in Europe might function on the euro that's performing better than the US dollar or Canadian dollar, and this can actually hedge our risk as well. It also allows access to a wider range of opportunities, since there's various different investments all over the world in different countries and different sectors. And it reduces industry concentration as well, since this can be very volatile, especially with the supply shortages we've seen in the past couple of years. So again, it tells us that it reduces all these risks, and it's important that diversification doesn't guarantee profit. Now I just went full out and said, build me a diversified portfolio to invest $100,000. This is what we want to do with our paper trading account. So first of all, it gives us a wide overview of just how to invest this. So it says $50,000 or 50% of our investment in stocks. And it gives us some examples of which ones to look for in terms of index funds. And it also says to have a small percentage in international stocks as well. It then says to put 25% or $25,000 into bonds. This can be various total market bonds or a short-term index bond. And it can help provide stable income. Next $15,000 or 15% is said to be put in real estate through REITs or various crowdfunding platforms, and it can be a great stream of income as well. And finally, $10,000 or 10% in cash in case there is some kind of downturn, we want to invest some or more of our money. And this is it just tells us this is a allocation it came up with. It's not by any means set in stone, but it's a good way to diversify. And now I kind of narrow it down a little bit more and say, what if I want to put the entire $100,000 into strictly stocks? Again, this isn't by any means the best practice. Don't follow this as investment advice. I'm just kind of doing it to see if we can build a portfolio in our paper trading account that we're going to do in order to see how good the recommendations that ChatGPT gives us do over time as investments. So here we see that it's telling us that it's not a good idea, it's a high-risk strategy to put it all into stocks, but again, here it starts giving us some suggestions, which is great. This is exactly what we wanted. So it gives us Apple, which is of course one of the most valuable and largest technology companies. It also gives us Amazon, which is surprising since it's been a little bit undervalued, but again, it has this only data since end of 2021. And it also gives us Microsoft and Facebook as well as Berkshire Hathaway, but the Class A shares. So for the portfolio, I'm thinking to do Class B, since Class A is very expensive per share. And so these are just examples. I didn't think 5 was enough to actually build a portfolio from, so I asked it for a couple more suggestions here, and that weren't only strictly tech stocks, except for Berkshire Hathaway, just to give us a more well-rounded portfolio, but strictly still using ChatGPT to facilitate this. So it goes ahead and gives me a couple more, which is fantastic. I didn't have this much luck before, but here it's giving us Johnson & Johnson, which is a healthcare company, Procter & Gamble, which is a consumer goods company, Visa, which is a large payment processor, as you might know, Nestle, which is an interesting choice, and I didn't actually include since it was only traded on the Swiss exchange, Goldman Sachs, and Cisco Systems, which is a lot more diversified than I was expecting to get, which is great. So I decided to invest in these 11 companies. I decided to end up doing 10 and doing a little bit more in some of them. So we didn't invest the full 100,000, but yeah, this is very interesting. All right, just fast forwarding here. I'm using the Investopedia trading account here, and you can see that I've placed trades here for all of these orders. The shares indicate a 1/11th of the total $100,000 that's been allocated. And again, I didn't include Nestle since it was a little bit more, so I added Kellogg's here instead. So they're equally in each, just under 10% in each one of them, and the total is $100,000. We'll check back on this in about a month.